Welcome to the deep dive. Ever wonder what truly keeps a massive company's financial gears turning smoothly, beyond the daily grind of sales and purchases?
Hmm.
It's not always the headline-grabbing transactions that define financial health.
No, that's absolutely right.
Today, we're pulling back the curtain on some of the most fascinating, I think, other transaction cycles. These are absolutely crucial, yet they often fly completely under the radar.
That's spot on. While revenue pouring in and, money going out for expenses are certainly vital, a company's deep-seated stability
Hmm.
and the sheer accuracy of its financial statements, well, they also hinge on how meticulously it manages its long-term assets, its entire workforce, and its fundamental funding.
Right.
These are indeed the unsung heroes of financial reporting, and grasping them offers you, the listener, a much deeper, more holistic appreciation for a company's very operational backbone.
Okay, let's unpack this. We're going to dive headfirst into the nitty-gritty of how businesses keep track of incredibly significant things. Think massive factories and production lines, um, thousands of employees across the globe, and the monumental loans or equity investments that fuel their growth.
Hmm.
Specifically, we're going to explore the property, plant and equipment, payroll and personnel, and the financing cycles.
The big three others.
Exactly. Our mission for this deep dive is to reveal the essential internal controls and the often meticulous audit procedures that truly safeguard a company's financial health and its integrity in these often overlooked areas.
Yeah, getting into the real mechanics.
You're going to gain a comprehensive understanding with a lot of clarity and, dare I say, some genuinely surprising insights into these vital underlying processes. So let's kick things off with property, plant, and equipment, universally known as PP&E in the financial world. We constantly hear about a company's assets, but what exactly falls under this umbrella, and why is this particular category so incredibly important, not just for the company, but for, anyone trying to understand its true value?
Right, PP&E. So at its core, PP&E refers to all the tangible assets a business owns that are built to last. We're talking about assets with a service life of more than 1 year.
Okay, more than a year.
And assets actively used in the operations of the business. Think manufacturing, delivery, administration. And crucially, they are not acquired with the intention of immediate resale.
Ah, so not inventory.
Exactly, not inventory. Imagine them as the sort of foundational infrastructure and heavy-duty tools that enable a company to do what it does day in and day out for the long haul.
So if a company makes widgets, we're not talking about the widgets themselves, which are inventory. We're talking about the colossal machines that make the widgets or the building where they make them. Give us a few concrete, real-world examples.
Perfect analogy. Yes.
Yeah.
Picture a sprawling, humming factory building, perhaps one that spans acres that's classic PP&E.
Okay.
Or the specialized high-tech machinery inside that factory designed for a specific production line.
Mm.
It could be an entire fleet of company delivery vehicles, heavy construction equipment on a job site, or even the extensive IT infrastructure and servers that power a tech giant. These are often enormous multi-million or even multi-billion-dollar investments for a company.
Huge sums.
Absolutely. They form the absolute physical backbone of its operations. They're not just figures on a balance sheet. They are the tangible manifestation of a company's productive capacity, its ability to generate revenue and innovate into the future.
That makes a lot of sense. These are the things a business truly relies on, often for decades, to generate revenue. And I imagine their life cycle involves much more than just buying them once. What are the major types of transactions that ripple through this PP&E cycle?
You're absolutely right. It's a full dynamic life cycle. It begins, of course, with the initial purchase or construction of these assets. Think of a pharmaceutical company buying land and building a new research facility.
Right, the big upfront cost.
Then, throughout their long, useful life, there's ongoing repairs and maintenance to keep them in peak working order.
Keeping the machines running.
Exactly. A very critical part of this cycle is depreciation, which is the systematic accounting process of spreading the cost of the asset over its useful life. This reflects how the asset's economic value is used up or consumed over time.
Okay, depreciation, we hear that a lot.
And finally, there's disposal, when assets are sold, retired, or perhaps even scrapped because they're no longer needed, are technologically obsolete, or simply worn out.
End of life.
Right. We also increasingly see leasing as a significant transaction, where companies might choose to lease high-value assets rather than own them outright, which has its own complex accounting implications.
So why does all this PP&E detail matter to you, the listener? I mean, beyond knowing what a factory is, What's the real tangible relevance of understanding this cycle for, say, an investor, an employee, or even a customer?
It's absolutely vital because these assets often represent a significant and frequently the largest portion of a company's total reported value on its balance sheet.
Okay, a huge chunk of the value.
Yes, they directly influence a company's capacity to generate future revenue, its efficiency, and are a cornerstone of its long-term strategic direction. Now, here's where the insight comes in. Mismanagement, or worse, deliberate misrepresentation in how PP&E is acquired, maintained, depreciated, or disposed of can drastically distort a company's financial statements. Well, if a company overstates the value of its assets or fails to properly depreciate them, its reported profits can look vastly better than they actually are, completely misleading investors and other stakeholders.
Making things look rosier than reality?
Precisely. Think of a startup that pumps up the value of its proprietary software or brand assets without proper justification. It allows them to burn through investor cash while reporting inflated profits. An auditor uncovering an impairment here can literally collapse the whole house of cards overnight.
Wow.
It's about understanding the true economic health, operational capacity, and underlying trustworthiness of a business, not just its advertised numbers.
So if these assets are so utterly crucial and represent such massive investments, it stands to reason that companies would have incredibly tight, almost impenetrable controls around them. While general financial controls apply everywhere, I imagine PP&E has some seriously unique requirements because of how specialized, immobile, and valuable these items are. What are some of the key internal safeguards, the blueprint for control for PP&E?
Absolutely. The unique nature and, frankly, the very high value of PP&E necessitates an exceptionally robust system of internal controls. It's not just about preventing theft, though that's part of it.
Right.
It's about ensuring these significant investments are made wisely, tracked accurately throughout their long lives, and protected appropriately until their very end.
Let's start at the very beginning. Acquisition controls. This sounds like the gatekeepers of investment. How do companies make sure they're not just buying incredibly expensive things without proper oversight, or even worse, wasting capital on something unnecessary?
Exactly. They are the critical gatekeepers. When a company decides to acquire a new significant piece of PP&E, it's never a casual decision. It typically starts with what's called a special requisition form.
Okay, a special form. Sounds important.
It is. This form isn't just a simple request. It's incredibly detailed. It includes a precise description of the asset, the exact reason for its acquisition, why is it needed, specific account to be charged, and its probable cost, often with detailed breakdowns.
So a full justification.
Yes. And this isn't just a suggestion. This form then requires multi-level approval, often escalating to top management or even the executive committee.
So it's not just a department head signing off on a new multi-million-dollar machine. No instant Amazon Prime delivery for a new factory, then.
No, absolutely not. Not even close. These acquisitions are profoundly tied to the company's overarching capital budget.
The budget.
Right, which itself is a strategic document, often approved by the board of directors months, sometimes even a year in advance. This stringent level of approval ensures that large capital expenditures align directly with the company's long-term strategic goals and its financial capacity.
Makes sense.
Furthermore, any variances from this approved capital budget, say a project suddenly comes in significantly over its allocated budget, or a purchase price is higher than expected, must be promptly investigated and explained.
Accountability.
Crucial. This step prevents unchecked cost overruns and, importantly, unauthorized spending that could siphon off valuable capital. For assets above a certain monetary threshold, often quite a low one actually, the board of directors themselves must provide specific approval.
Even if it was in the budget.
Yes. Whether purchased externally or constructed internally, that extra layer of board sign-off is often required for the really big ticket items.
So for an auditor coming in, this is one of their first and most critical stops. They're verifying that the process was followed, not just the outcome.
Precisely. The auditor's first critical check is to ensure that the company's own rigorous policy was followed to the letter, and that all fixed asset purchases were properly authorized at the appropriate, typically very senior levels.
Why such strictness?
Well, this strict authorization process is vital because these are not everyday purchases. They involve substantial capital outflow, commit the company's resources for years, and have long-term strategic implications for the company's operations and competitive position. It's fundamentally about preventing wasteful or misdirected spending and ensuring every single investment truly aligns with the company's overarching mission and financial well-being.
That makes perfect sense. Once an asset is acquired and improved, how do companies keep track of it over its long life? I imagine it's more than just a general ledger entry for big machine, #1.
It is, absolutely. This is where subsidiary ledgers come in. I like to think of them as the asset's incredibly detailed biography or a comprehensive passport for every single piece of equipment.
A passport for a machine. I like that.
Yeah. For each individual piece of PP&E, the subsidiary ledger holds a wealth of detailed information. This includes the asset's precise description, a unique identification number, often a barcode or serial number.
Like a VIN number on a car.
Sort of, yeah. Its exact physical location within the company, the precise acquisition date, its original cost, the chosen depreciation method used to spread its cost over time, whether it's straight line, declining balance, or another method, and, crucially, the accumulated depreciation amount up to any given point.
So it's literally like a detailed dossier for every single piece of equipment, from a forklift to a factory building.
Exactly. This ledger is absolutely crucial for accurate accounting, for efficiently tracking the asset's entire life cycle, and for making informed future decisions about replacements, upgrades, or dispositions. Without this meticulous level of detail, knowing the true value, precise location, and remaining useful life of all assets would be nearly impossible, inviting errors, inefficiency, and even potential fraud.
What about actually protecting these tangible assets? I mean, a massive factory building isn't going to get up and walk away, but machinery could be damaged or stolen piece by piece or just inexplicably disappear over time.
That's where physical security becomes paramount. Fixed assets should have clear, durable identification plates or tags, similar to a serial number, and this number should correspond directly to the control account in the general ledger and the detailed subsidiary ledger.
Tagging everything.
Pretty much. Beyond just tagging, layered physical controls are absolutely necessary to safeguard assets from theft, destruction, or unauthorized disposition. This could include controlled access to facilities, 24/7 security personnel, robust alarm systems, and appropriate environmental controls to protect sensitive equipment.
Right.
Crucially, companies should conduct periodic physical inspections of their entire plant and equipment base.
Meaning actually going out and looking.
Literally sending teams out to verify that the assets listed in the records actually exist, are in the stated condition, and are still in use.
And the auditor plays a direct role here too, right? They don't just trust the company's internal count.
Yes, absolutely. Auditors will, on a sample basis, compare the serial numbers or tags on these physical identification plates to what's listed in the company's records. They'll also critically assess the robustness of the physical security measures themselves. Think of a company asset being tagged and tracked like a valuable piece of art in a museum. It's about knowing exactly what you have, precisely where it is, and that it's adequately protected from harm or disappearance.
Beyond the physical security, what about the actual accounting rules governing how these assets are treated on the books? That sounds like a place where things could get incredibly tricky and potentially lead to misrepresentations.
Indeed. This leads us to the absolute necessity of written policies. Having clearly documented, consistently applied depreciation policies and records is essential for accurate and comparable financial reporting.
Why consistency?
Well, if a company were to suddenly change its depreciation method without a valid disclosed reason, or apply it inconsistently across similar assets, it could significantly and artificially alter its reported profits year over year.
Yeah.
Even more critical are specific capitalization policies.
You mentioned this briefly earlier, but let's double-click on it. What's the fundamental difference between capitalizing an expense and just expensing it immediately? Why are those policies so incredibly vital, and where do companies sometimes get it wrong, intentionally or unintentionally?
This is a really important and often misunderstood distinction that directly impacts a company's reported profitability. When a company incurs a cost, it generally has two primary options for accounting treatment: to expense it or to capitalize it.
Okay, expense or capitalize.
If you expense a cost, it's recorded as an immediate outflow on the income statement, directly reducing profit in the current period. Think of a minor routine repair to a machine that's typically expensed. It's gone.
Right, hits the bottom line now.
If you capitalize a cost, however, it's added to the asset's value on the balance sheet and then systematically depreciated over its useful life, meaning the cost is spread out and impacts profits over many years.
Okay, like a long-term investment.
Exactly. Think of a major engine overhaul that significantly extends a machine's life, or a new addition to a building. Those would typically be capitalized.
So where's the potential problem?
Where it gets tricky is when companies try to misclassify. For instance, if a company expenses something that should have been capitalized, it immediately reduces current period profits and understates its assets.
Making profits look worse now.
Right. Conversely, and often more enticingly, if a company capitalizes something that should have been expensed, it can artificially boost current period profits by deferring the cost into future periods.
Ah, pushing the cost down the road to look better today.
Precisely. These policies are critical because they directly and profoundly impact a company's reported profitability, its stated asset values, and even its tax obligations. Clear, consistently applied written policies are the rulebook for ensuring this critical distinction is always handled accurately and transparently.
So these policies are the veritable rulebook for consistency and accuracy, preventing companies from manipulating their reported earnings. And finally, assets don't last forever. What happens when they reach the end of their useful life or are simply sold off?
That's the disposition part of the cycle, and it also requires exceptionally careful control. Retirements or sales of assets must be thoroughly documented on a sequentially numbered work order.
Another form.
Yes, documentation is key. This form needs to include clear evidence of proper authorization for the disposal and the precise reason for it, whether it's obsolescence, damage, or simply being sold off.
Okay.
This asset retirement order form is the basis for recording any cash received from the sale of the asset and, crucially, for accurately removing the asset and its accumulated depreciation from the subsidiary ledger and the general ledger.
Cleaning up the books.
Exactly. A paramount control here is the segregation of duties. The person with the authority to dispose of an asset should not be the one who has physical custody of the asset or is involved in its actual disposal, such as handling the sale or scrapping it.
Why is that particular segregation so incredibly important? It sounds like a detail, but it could hide a bigger problem.
It's an absolutely critical fraud prevention measure. Without it, an unscrupulous individual could, authorize the disposal of an asset, physically remove it, sell it off the books, and then quietly pocket the proceeds, all without proper accounting or detection.
Wow, okay. So selling company property on the side.
Potentially, yes.
Okay.
Proper segregation ensures that assets aren't disposed of, or worse, stolen without transparent, authorized, and independently verified accounting for the entire transaction. It's all about ensuring that every piece of PP&E, from its acquisition to its final disposition, is meticulously tracked, accounted for, and protected throughout its entire journey within the company.
So that's the company's internal system of checks and balances. But then comes the external auditor, the independent third party, who needs to verify that all this isn't just theoretical. Auditors don't just check if controls are in place. They perform incredibly detailed procedures on the actual financial balances and transactions themselves. What does that toolkit look like specifically for PP&E?
You're right. The auditor's role is multifaceted, like a financial detective. They don't just take the company's word for it. They dig deep into the numbers and the processes to gather objective evidence. We can break this down into three main areas: auditing the balance sheet figures, auditing the transactions that occurred, and finally, auditing how it's all presented to the public. Hashtag tag 1.3.1, auditing the PP&E balance, the snapshot.
Let's start with auditing the PP&E balance. This is like taking a snapshot of what the company claims to own at a specific point in time, usually year-end. The big questions an auditor is asking are, is everything they claim to own really there? Is it worth what they say it is? And do they truly own it free and clear?
Exactly. Those are the key assertions. For the first question, is everything really there, and have we counted it all? This relates to completeness in existence.
Right.
The auditor will obtain and foot, meaning sum up the company's detailed fixed asset schedule and make sure that this total precisely matches the general ledger balance.
Checking the math, basically.
Yes, but also the reconciliation. They also get schedules of additions and dispositions and ensure these amounts agree to the fixed asset schedule. But here's a crucial hands-on step. They select a sample of actual fixed assets, real, physical items, and then physically go and inspect them.
Physically look at the machines.
Yes. They trace these physical assets back to the fixed asset subsidiary ledger. This is like a detective ensuring every piece of the puzzle is present and fits. If a physical asset can't be found in the ledger, it might signal an unrecorded asset or, more concerningly, a tracking or even a fraud issue. We also test existence by vouching additions back to invoices and inspecting the asset, and by selecting older assets from the ledger and physically locating them to check for unrecorded retirements.
Making sure things haven't disappeared off the books or things on the books haven't disappeared physically.
Precisely. What about the second big question? Is it worth what we say it is? This addresses valuation and allocation. How do they know if the asset's value is truly represented, especially after all that depreciation has chipped away at its original cost? This is where the numbers get crunched and where significant judgment is often involved. Auditors will recalculate accumulated depreciation on a test basis to ensure it's reasonable and aligns with the company's stated policies and generally accepted accounting principles. At JP.
Checking the depreciation math.
Yes. They also critically evaluate fixed assets for impairment. This is a huge one. Impairment occurs when an asset's book value is no longer recoverable, perhaps due to a sudden downturn in its market value, significant physical damage, or technological obsolescence that makes it less useful.
Like a machine that makes something nobody wants anymore.
Exactly. The auditor examines the entity's documented impairment analysis, identifies circumstances that could suggest impairment, like that product line being discontinued, and reperforms the company's analysis to check the reasonableness of any recorded losses.
They redo the company's math on impairment.
They assess the reasonableness of the company's analysis and conclusion, yes. If a company uses International Financial Reporting Standards, or IFRS, the auditor will also verify the reasonableness of any fixed asset revaluations, which IFRS sometimes allows for certain assets.
So if a company's main factory building is suddenly half empty because a major product line got discontinued, the auditor would make sure the company adjusts its value downward to reflect that new reality. That's about painting an honest picture.
Precisely. They ensure the company acknowledges the true economic reality of its assets, not just the historical cost. For the do they truly own it question referred to as rights and obligations, auditors examine invoices, deeds, and title documents.
Proof of ownership.
Exactly. This is crucial for assessing if the company truly has legal title to the assets, or if there are any liens, mortgages, or other claims against them, which could impact the company's financial backing or ability to use the asset freely. Hashtag 1.3.2. Auditing PP&E transactions. The flow.
So that covers the snapshot of the balance at a point in time. But what about the ongoing flow of transactions throughout the year, all those purchases, sales, and the big capital expenditures?
Right, the activity during the year. Many of these tests are performed as dual-purpose tests.
Dual purpose?
Meaning they serve a dual function. They check both the effectiveness of internal controls and the accuracy of the financial balances simultaneously. It makes the audit process much more efficient.
Okay, smart. Let's talk about ensuring completeness again, but for transactions. How do they make sure all new purchases and changes to PP&E are recorded?
For completeness of additions, the auditor will trace a sample of fixed asset purchase requisitions through the receiving reports and into the fixed asset subsidiary ledger. This ensures that authorized purchases are properly recorded.
Following the paper trail.
Exactly. And here's a common trick companies try to pull that auditors look for. They will meticulously review related repair and maintenance expense accounts.
Why those accounts? Repairs and maintenance aren't PP&E, right? They're expenses.
You're absolutely right. They're typically expenses. But the auditor is looking for large, unusual items that were recorded as repairs that, according to GAAP and the company's own capitalization policies, should have been capitalized as an asset addition.
Ah, the capitalization versus expensing issue again.
Yes. This is a common tactic companies might use to either immediately reduce their taxable income by expensing something that should be spread out, or conversely, to artificially boost current period reported profits by deferring the cost into the future.
Sneaky.
It can be. It's a subtle but powerful way to manipulate the income statement. The auditor also reviews lease agreements thoroughly to ensure proper classification as finance or capital leases versus operating leases, as these have vastly different financial reporting treatments and impacts on the balance sheet.
That's fascinating. So they're looking for things that are intentionally miscategorized to improve the look of the financial statements. What about cutoff? Ensuring things are in the right year.
Cutoff tests ensure that transactions are recorded in the correct accounting period. Auditors will carefully review fixed asset purchases and dispositions from shortly before and after the year-end balance sheet date to confirm they've been recorded in the proper period.
So no pushing expenses into next year or pulling revenues into this year.
Precisely. It prevents amounts from being accidentally or intentionally pushed into the next year or pulled into the current one, which could manipulate reported results.
And then for valuation, allocation, and accuracy of these transactions, this sounds like a lot of recalculating and cross-referencing.
It is indeed. The auditor tests the accuracy and valuation of PP&E additions and disposals through several key procedures. They recalculate depreciation expense on a test basis to ensure it's reasonable and conforms to GAAP.
Checking the depreciation again.
They also meticulously test the calculation of gains and losses on the sale or retirement of fixed assets and verify the proper removal of the original asset cost and its accumulated depreciation for those disposed assets, all to ensure the accounting is accurate and complete.
And for existence and occurrence of these transactions, making sure the purchases really happened and the disposals were legitimate.
They will vouch a sample of purchases to the receiving report and the vendor invoice, ensuring the purchase actually happened and the asset was received.
Vouching means matching documents.
Yes, tracing from the accounting records back to the source documents. Similarly, they'll vouch a sample of dispositions to the asset retirement form and other supporting documentation, confirming the retirement was legitimate, properly authorized, and the asset is indeed off the books. Tag 1.3.3, auditing presentation and disclosure, what the public sees.
Once all the internal checks and transaction deep dives are done, the final crucial piece is how this information is actually presented in the company's financial statements and, importantly, in the accompanying notes. What does the auditor look for regarding completeness of disclosures here?
Right, the footnotes. It's vital that all required disclosures related to fixed assets are meticulously included in the notes to the financial statements. These are critical for investors and other stakeholders to fully understand the company's asset base and its accounting policies.
What kind of things need to be disclosed?
The auditor specifically ensures the company clearly discloses its depreciation methods and useful lives for various asset classes, the depreciation expense for the current period, the balance of each significant class of capital assets by nature or function, by example, land, buildings, machinery, and the corresponding accumulated depreciation allowances.
Okay, the basics.
Yes, but also any liens and mortgages on fixed assets, meaning if they've been pledged as collateral for debt, must be disclosed, along with detailed finance and operating lease information.
So it's not just about the numbers, but the complete, transparent story behind those numbers that truly matters to an informed reader. What about valuation, allocation, and accuracy in these disclosures?
The auditor will meticulously read the footnotes and other related information to confirm that the narrative information is accurate and that the amounts disclosed are appropriate and consistent with their audit findings. They're making sure the narrative aligns precisely with the underlying audited data.
And for rights and obligations and occurrence in the disclosures, making sure they own what they say and the disclosed events happened.
Auditors will inquire of management and review key loan agreements and board minutes to determine if fixed assets have been pledged as collateral for loans. This is a key disclosure because it affects the company's ability to borrow more, or what would happen if they defaulted on existing loans.
Right, important context.
Exactly. They'll also compare the disclosures with other audit evidence they've gathered to ensure that all disclosed information related to fixed assets has genuinely occurred and is factually correct.
And finally, understandability of presentation and classification. This is where clarity for the average user comes in.
Exactly. The auditor reads the required disclosures from the perspective of an informed user, like yourself, to ensure they are clear, comprehensive, and easy to comprehend. This transparency in details is absolutely crucial for investors and other stakeholders to make informed, sound decisions about the company's financial health, its long-term stability, and its underlying trustworthiness. The PP&E cycle, though complex, truly is the bedrock of a company's productive capacity and its long-term financial integrity.
Now let's shift gears completely to another absolutely vital but often incredibly high-risk cycle, payroll and personnel. This is where a company interacts with, pays, and manages its most valuable asset, its people. What are the biggest, most insidious risks here that auditors are constantly looking for?
The stakes are indeed very high, and the risks in this cycle are very concentrated and can be incredibly damaging. The two most significant and common risks in the payroll and personnel cycle are the creation of fictitious employees.
Ghost workers.
Exactly. Paying people who don't actually exist and then siphoning off their paychecks. And the second major one is the falsification of hours worked.
Padding the timesheet.
Right.
Mm-hmm.
Legitimate employees being paid for more hours than they actually put in, or at higher rates than they should be. Both of these lead directly to significant financial loss for the company and can be incredibly difficult to detect if internal controls are weak or bypassed. It's truly about safeguarding the human element of finance. Hashtag 2.1.1, the role of service organizations.
And I know a lot of companies, especially smaller ones or even medium-sized ones, outsource their entire payroll processing to third-party service providers like ADP or Paychex. Does that mean the company simply washes their hands of responsibility once it hands over the data?
That's a very common misconception and a crucial point. Many entities indeed use service organization to process their payroll transactions. However, and this is a critical principle in auditing, the service organization's controls are legally considered part of the user entity's information system if those services affect how transactions are initiated, executed, processed, or reported in the user company's financial statements.
So the company is still on the hook.
Absolutely. This means the user company cannot simply outsource their responsibility for financial accuracy and integrity. They still need robust assurance that the service provider has strong internal controls in place, because those controls directly impact the accuracy and validity of their own financial reporting.
How did they get that assurance?
Well, the auditor of the user entity will often need to obtain assurance over the service organization's controls, sometimes through what's called a SOC1 report, which details the service organization's internal control environment. Hashtag 2.1.2 segregation of duties, the unbreakable chain of trust.
So, even with outsourcing, the concept of segregation of duties remains paramount. How is that meticulously structured in the payroll cycle to prevent those big risks like fictitious employees or falsified hours? It sounds like a complex dance of responsibility.
It really is. Proper segregation of duties is absolutely essential here. It's meticulously designed to create a system of overlapping checks and balances where no single person has too much control or the ability to perpetrate and conceal a fraud.
Let's start with the very beginning. Authorization to employ and pay. Who gets to decide who's on the payroll?
This function is typically the exclusive domain of the Human Resources HR department. HR is responsible for hiring new employees, which originates from authorized requisitions from the user departments that actually need staff.
So HR controls who gets added.
Correct. HR maintains all the core personnel records. The employee's official hire date, their assigned department, their agreed-upon salary or wage rate, and their specific position. This is the initial gatekeeper, ensuring that anyone who legitimately gets paid is, in fact, a legitimate authorized employee.
Once someone is hired and on the books, their day-to-day work, their hours, their leave, all that needs to be tracked. Who handles that crucial part?
That falls under the purview of supervision. An employee's immediate supervisor, the person who directly oversees their work, must explicitly approve all pay-based data.
Pay-based data.
Things like the actual hours worked, any absences, and any approved time off, such as vacation or sick leave. Their signature or digital approval confirms that the employee was actually present, performed the work being claimed, and adhered to company policy.
And what about the actual physical tracking of time? Is that separate from the supervisor's approval, or can the supervisor also punch a time card?
Oh no, it should definitely be separate. This is the responsibility of timekeeping and cost accounting. The data on which pay is based, such as hours worked or jobs completed for a specific project, should be accumulated independently of other functions.
How is that usually done?
For hourly employees, it's highly advisable to use mechanical or electronic time clocks. Department supervisors should then compare job time tickets with employee clock cards that have been signed by the employee, adding another crucial layer of verification that minimizes manipulation.
And salaried folks?
Salaried employees don't typically use physical timesheets in the same way, but they might still be required to submit reports for vacation, sick leave, or overtime, which also require independent tracking. The key is that the recording of time is done in a way that minimizes any single point of failure or manipulation.
So we have HR authorizing hiring, supervisors approving hours, and a separate group tracking the time. Now, who actually calculates the gross and net pay and prepares the checks or direct deposits?
That's a dedicated payroll department. They compute the salary or wages based on the information received from HR and timekeeping, like total hours worked for hourly employees.
The number crunchers.
Exactly. If the company doesn't use a service organization, this department is responsible for issuing the unsigned payroll checks or initiating direct deposit files. These checks, if physical, are then sent to the treasurer or chief financial officer for final signature, or for supervision of a secure check signature plate if one is used.
Security around the signing is key, I imagine.
Oh, absolutely. Critical controls must be in place over access to blank checks and check signature plates to prevent any unauthorized use or fraudulent creation of payments.
And here's where we get to another passkey insight, right? The payroll department is explicitly a record-keeping department, and that's a very deliberate distinction.
Precisely. Remember, the payroll department is fundamentally a record-keeping department, not a custodial department. Although employees in this department meticulously compute salaries, create the payroll register, and prepare unsigned checks or direct deposit files.
They don't hold the money or sign the checks.
Exactly. They should have neither the authority to initiate changes in employee hours or pay rates, nor the ability to sign checks or authorize transfers from the bank account. This is an absolutely critical fraud prevention measure.
Why?
Well, if the same person could both change pay rates and sign checks, it would be alarmingly easy to create and conceal fraudulent payments to fictitious employees or to inflate payments to real ones.
Makes sense. Keep those functions separate.
Okay, checks or direct deposits are prepared and authorized. Who actually hands them out or verifies the final payout?
In many companies today, payroll is predominantly handled through direct deposit into employees' bank accounts, which simplifies controls significantly by removing the physical check handling.
Much easier, I bet.
It is. However, if physical paychecks are manually distributed, then the checks must be distributed by a person who has no other payroll function.
A totally separate person again. Yes. No HR, timekeeping, or payroll calculation duties. In larger corporations, this individual is often referred to as the paymaster. Employees should be required to show some form of identification before receiving their paychecks to prevent checks from being given to the wrong person, or, more insidiously, a fictitious one.
What about checks that aren't picked up?
Good question. Any unclaimed payroll checks must be immediately investigated by an independent party never held onto by the payroll department itself.
And does anyone verify all these pieces are actually working together in harmony or check for patterns of potential fraud, like a final overview?
Yes, the internal auditing department plays a crucial overarching role here. They periodically compare the personnel files maintained by HR with the payroll files and the timekeeping records.
Connecting all the dots.
Exactly. This comprehensive reconciliation helps ensure that only authorized payments have been made in the proper amounts to appropriate existing personnel and that the payments align with reported hours. Each step from hiring to payout is a deliberate check and balance, meticulously designed to prevent fraudulent payments or the theft of company resources through the payroll system. It's a continuous, multi-layered defense.
That's a really strong control framework. Now, how does the external auditor verify all this? How do they ensure that a company isn't secretly paying ghost employees or overpaying people?
The external auditor's watch involves both meticulously evaluating the system of internal control and performing detailed, substantive tests on the financial balances and transactions themselves. It's an active process of inquiry, observation, and verification. Hashtag 2.2.1, evaluating the system of internal control. Are the protections in place?
How does an auditor assess if these controls provide reasonable assurance that payroll is accurate and legitimate? Is it just looking at flowcharts, or is it more hands-on?
It's definitely more hands-on. The auditor first needs to evaluate whether the controls provide reasonable assurance that only valid employees are being paid, that payment is for the actual hours worked, and that the correct authorized rate of pay is used.
So, checking the design first.
Checking the design, yes, but also testing if it's operating effectively. This isn't just about reviewing policy documents. It involves active observation and detailed testing. Key procedures include observing the actual segregation of duties between human resource responsibilities, timekeeping, and payroll distribution.
Watching people do their jobs.
In a way, yes. They'll physically compare the personnel records for each department with the actual time cards, and critically, with the employees actually present and working in each department.
So they might actually walk the factory floor or the office space unannounced and see who's there, cross-referencing against the payroll.
Exactly. A powerful and common test is to observe payroll distribution on an unannounced basis.
Surprise. Auditors here.
Well, something like that. This is done to ensure that all personnel being paid are actually employed by the company and are physically present. It's a very direct way to catch fictitious employees or gross misrepresentations.
Makes sense.
They'll also observe the use of time clocks and investigate any unused or suspicious time cards. If direct deposit is used, they'll test the electronic transfers and verify the underlying employee authorizations for direct deposit accounts.
Checking the bank details.
Right. Finally, they test general and application controls within the payroll system itself to ensure transactions are valid, properly authorized, complete, and accurately recorded.
Like testing the software.
Yes, testing the controls within the software. For example, they might use range tests for hours worked, making sure no one is clocked in for, say, 100 hours in a standard work week.
Seems unlikely.
Highly. Or reasonableness tests comparing current period payroll to prior periods or budgets. They also test to ensure that only existing employees listed in the computer files are accepted by the system during payroll processing. This isn't just about paperwork. It's active observation and system testing to catch real-world discrepancies and ensure the integrity of the entire payroll system. Hashtag 2.2.2, auditing the payroll accrual, money owed for work done.
After evaluating the controls and finding them strong, what's next? What about payroll accruals, the money owed for work that's been done but not yet paid, like wages earned in the last few days of the year or accrued vacation time?
You're touching on a key efficiency point. When the system of internal control over payroll is assessed as effective, auditors can often focus their substantive procedures primarily on sophisticated analytical procedures and the straightforward recalculation of year-end payroll accruals for the valuation assertion.
So less detailed testing if controls are good.
Generally, yes. Tests related to completeness, existence, and rights and obligations might be less extensive if the controls are demonstrably strong and working. It allows for a more risk-based, efficient approach.
How do they check the accrual itself then?
For completeness, the auditor tests the completeness of the payroll accrual when performing the broader search for unrecorded liabilities, making sure all liabilities that should be there are actually captured.
Okay.
For valuation and allocation, they will independently recalculate any year-end payroll accrual, such as for wages earned but not yet paid, or accrued vacation and sick leave, and compare their calculated amount to the amount reported by the company on its financial statements.
Checking the company's math on the accrual.
Correct. For existence, they vouch amounts from the client's calculation of the payroll accrual to supporting documentation, like employee contracts and time records. And for rights and obligations, they examine supporting documentation to verify that the payroll accrual is indeed a legitimate obligation of the entity, ensuring it's not some kind of related party debt disguised as payroll. This ensures an accurate and complete reflection of the company's short-term liabilities to its workforce. Hashtag 2.2.3 auditing payroll transactions, the actual payments.
What about the actual payroll transactions, the multitude of payments themselves throughout the year?
Again, these are often performed as dual-purpose tests. For completeness, the auditor will trace a sample of employee time cards or approved time reports to the payroll register, ensuring that all time worked is properly recorded for payment.
Making sure everyone who worked got recorded.
Right. For cutoff, they'll meticulously examine a sample of time cards from shortly before and after the year end and compare them with the payroll report to determine whether the transactions were recorded in the proper accounting period. This prevents shifting expenses between fiscal years to manipulate earnings.
And for valuation, allocation, and accuracy of these payments. This sounds like a lot of detailed recalculating to ensure every dime is accounted for correctly.
It is, and it's absolutely crucial. The auditor tests the accuracy and valuation of payroll expense through several detailed procedures. They compare total recorded payroll with total payroll checks issued or direct deposit amounts transferred.
Matching totals.
Yes. They test extensions and footings of payroll calculations, making sure the math adds up. They verify individual pay rates and payroll deductions with employee records from the HR department and authorized deduction forms.
Checking rates and deductions.
They recalculate gross and net pay on a test basis for a sample of employees. They compare payroll costs with industry standards or internal budgets for reasonableness, flagging any significant unexplained variances. And they recompute the mathematical accuracy of a sample of individual paychecks. This is the ultimate deep dive into the numbers, ensuring every calculation is absolutely correct.
What about confirming the existence and occurrence of the payments? How do they make sure the payments went to real people who actually worked?
Auditors will vouch time on payroll summaries by selecting a sample of entries from the payroll register and comparing them with approved time cards and time reports, confirming the hours were genuinely worked.
Matching time reports to payroll.
Yes. And critically, from a sample of payroll transactions, they will locate the related employee in the personnel files to verify their existence and current employment status, directly addressing that initial risk of fictitious employees.
Finding the actual person.
Exactly. Finally, for understandability of presentation and classification, they'll examine a sample of paychecks or payroll summaries to ensure they are properly classified into the correct expense accounts, for instance, making sure that what's recorded as manufacturing wages isn't actually administrative salaries. Hashtag 2.4 auditing presentation and disclosure, what the public learns about payroll.
And just like PP&E, there are crucial disclosures for payroll in the financial statements, aren't there? This is where transparency about employee benefits and obligations really comes in.
Absolutely. For completeness, the auditor ensures all required payroll-related disclosures are meticulously included in the notes to the financial statements. These are often extensive and include detailed pension and post-retirement benefit disclosures.
Big liabilities there.
Huge. Also, significant stock-based compensation disclosures, like stock options or restricted stock units, and comprehensive information on deferred compensation and profit-sharing plans. These give users a full, transparent picture of the company's employee-related liabilities and commitments, which can be massive.
So readers know the full cost of the workforce.
That's the goal. For valuation, allocation, and accuracy, they read these footnotes carefully to determine if the information is accurate and presented at the appropriate amounts consistent with their audit findings. For rights and obligations and occurrence, they inquire about accruals for proper disclosure and compare the disclosures to other audit evidence gathered. And for understandability of presentation and classification, they read these disclosures from the perspective of an informed user to ensure they are clear, comprehensive, and easy to comprehend. Transparency here is absolutely key for stakeholders to understand the true scope of the company's financial obligations to its workforce.
We've talked about the physical assets that make a company run, the people who operate it, and now we move to how companies actually fund all of this, the financing cycle. This truly is the lifeblood of business, isn't it? Without capital, nothing else happens.
It truly is the fundamental engine. The financing cycle encompasses how an entity obtains and manages its debt, which is essentially money borrowed from external parties.
Loans, bonds, etc.
Right. And its equity, which represents the ownership stake in the company held by shareholders.
Stock.
Exactly. This cycle is fundamentally important because it's how companies raise the enormous capital needed to operate, to invest in those crucial PP&E assets we discussed, to pay their employees, and ultimately to expand and grow.
It fuels everything else.
Pretty much. Without effective and tightly controlled management of this cycle, a company can very quickly find itself in severe financial distress, regardless of how strong its sales or operations might otherwise be. It's about building and maintaining financial resilience.
So how do companies ensure they secure this absolutely vital capital responsibly and manage it transparently? What are the key internal controls, especially over debt?
Controls over debt are meticulously designed to prevent unauthorized borrowing, to ensure that the company only takes on debt that it can manage, and to guarantee accurate reporting of liabilities and associated costs. First, adequate documentation for all financing agreements is absolutely crucial.
Get it in writing.
Always. Every loan agreement, every bond issuance needs comprehensive paperwork outlining all the precise terms, interest rates, repayment schedules, and any assets pledged as collateral. Second, new debt financing must be authorized at the highest levels, typically by the board of directors or top management.
High-level sign-off again?
Yes, this high level of approval ensures that significant financial commitments are strategic, financially sound, and appropriate for the company's long-term health. Third, the company must maintain detailed, up-to-date records of its long-term debt and perform periodic independent verification between the general ledger, the detailed debt records, and even the note holders or bondholders' records.
Cross-checking the records constantly.
It helps prevent errors and detect unauthorized debt. Finally, there must be adequate controls over interest and principal payments and over the proper recording of bond premium and discount amortization amounts. Debt carries significant obligations, miss a payment, and you're in default. These controls prevent unauthorized borrowing and ensure accurate, timely financial reporting of all liabilities.
That makes perfect sense. Debt is a huge liability, so you want to be incredibly careful. What about controls over equity, the ownership side of the ledger, which seems like it could be even more complex with shares and dividends?
Equity controls are equally critical, especially because they relate directly to ownership, the dilution of existing owners, and the proper declaration and payment of dividends. All stock issuances, dividend declarations, and treasury stock purchases when a company buys back its own shares must be formally authorized by the board of directors.
Board approval is key.
Absolutely. The evidence of these events should be meticulously recorded in the official minutes of board meetings. This is a non-negotiable step to prevent unauthorized share issuance or dividend payments that could harm shareholders.
I've heard of large companies using a stock transfer agent. What exactly is their role, and why are they so important for ensuring strong controls over equity?
Yes. Many large entities, particularly publicly traded ones, employ a stock transfer agent. This agent acts as an independent intermediary, and their role is absolutely vital for control and meticulous record-keeping for complex equity transactions.
An independent watchdog.
In essence, yes. They ensure that all stock issuances comply with the company's articles of incorporation, which are like the company's governing constitution and regulatory requirements. They prepare the actual stock certificates if they are still physical, and they maintain comprehensive records of shares authorized, issued, and outstanding.
So they handle the mechanics and keep the official record.
Correct. This external independent verification adds a significant and invaluable layer of control and accuracy to the entire equity process, minimizing the risk of errors or fraud.
So it's like having a neutral third party confirm everything is legitimate and on the up and up. But what if a company doesn't use a stock transfer agent? How do they manage these crucial controls internally without that external check?
Good question. If a stock transfer agent is not used, the entity must implement very strong internal controls internally to compensate for that lack of an independent third party. An officer of the entity must be explicitly responsible for ensuring all stock transactions comply with the articles of incorporation and regulatory requirements.
Someone specific internally is responsible.
Yes. Crucially, this officer also maintains the stock certificate book, which is a physical record of all issued and unissued certificates. A critical segregation of duties here is that the individual maintaining the stock certificate book must not have any accounting responsibilities related to equity.
Ah, that separation again. Can't manage the physical certificates and the accounting entries.
Precisely. This prevents them from manipulating both the physical records of ownership and the corresponding financial records. Additionally, there should be a periodic independent reconciliation of the stock certificate book with the total number of shares outstanding according to the general ledger.
Internal checks and balances.
Right. Without an agent, companies must meticulously track ownership internally to prevent fraud, such as issuing unauthorized shares, and to ensure the utmost accuracy in their ownership records. The stakes here are incredibly high because it involves the actual ownership of the company.
Given the absolute importance of debt and equity as the fuel for any enterprise, I imagine the auditor's scrutiny here is incredibly detailed and thorough. How do they approach auditing the debt balance?
Indeed. For the debt balance, the auditor is meticulously looking to confirm several key assertions. Completeness, is all debt accounted for? Valuation, is recorded at the correct amount? Existence, does the debt actually exist? And rights and obligations, is it truly the company's debt?
For completeness of debt, what's their approach? How do they ensure no hidden borrowing is lurking out there?
To ensure all debt, recorded and unrecorded, is accounted for, the auditor will review board minutes for evidence of any new debt authorizations.
Checking the meeting notes.
They'll obtain copies of all new debt agreements and trace these new debt contracts directly to the financial statements to ensure proper recording. They also obtain a complete listing of all outstanding debt and agree the total to the general ledger.
Matching the lists.
A crucial cross-check involves looking at any debt disclosed on standard bank confirmations. Banks often confirm a company's outstanding loans and lines of credit and tracing that to the company's debt agreements and financial statements.
Asking the bank directly.
Yes, and critically, notes and bonds should be confirmed directly with the creditors themselves. This third-party verification is incredibly strong evidence. Finally, they inquire extensively of management regarding any new debt entered into or any off-balance sheet financing transactions, which are structured to not appear on the balance sheet but still represent financial obligations.
Looking for things not obviously on the books.
Exactly. This is like a comprehensive search for any hidden borrowing or financial commitments a company might have that could impact its solvency.
That's a very thorough net to cast, clearly designed to uncover anything unexpected. And for valuation and allocation, making sure the debt is recorded at the right amount.
They'll examine new debt agreements to determine whether they were recorded at the proper amount on the balance sheet, including any associated fees, discounts, or premiums. They'll also recompute any interest payable at year-end and recompute the amortization of premiums or discounts on bonds to ensure the carrying value of the debt is accurately stated on the balance sheet.
Checking all the calculations related to the debt value.
Correct.
For existence of the debt. This seems straightforward. Does the loan actually exist?
This is indeed straightforward and powerful. The auditor will confirm notes or bonds directly with creditors. This independent third-party confirmation is robust evidence that the debt genuinely exists and is owed by the company.
And rights and obligations. Making sure it's really their debt.
They'll examine note and bond agreements thoroughly to verify that they are indeed the obligations of the entity itself, not, for example, a related party, a subsidiary, or a separate legal entity, which could complicate the company's liabilities. Hashtag 3.3.2, auditing debt transactions.
How do they audit the actual transactions involving debt throughout the year, like taking out a new loan, making an interest payment, or repaying principal?
Again, these are often performed as dual-purpose tests. For completeness, they'll examine new debt agreements and review board minutes for evidence of any new agreements entered into during the period.
Checking for new loans again?
Yes, and they also review interest expense for any payments made to debt holders that are not included in the existing debt listing, which could signal unrecorded debt.
Ah, looking for interest payments that don't match the known debt.
Exactly. They also examine lease agreements to ensure proper classification as operating or finance leases, as this impacts the company's balance sheet. For cutoff, they review debt activity shortly before and after year-end to ensure transactions are reported in the proper accounting period, preventing income or expenses from being shifted.
And for valuation, allocation, and accuracy of these transactions.
They test a sample of debt receipts and payments to verify the amounts recorded. They also perform analytical procedures, such as comparing total interest expense to the average debt balance for reasonableness.
Does the interest paid make sense given the amount borrowed?
Essentially, yes. If the interest expense seems unusually high or low for the reported debt, it could flag an issue, perhaps an incorrect interest rate or unrecorded debt.
For existence and occurrence of debt transactions.
They verify the existence of new debt by reviewing board minutes for evidence of new agreements and then physically inspecting the actual agreements themselves. Finally, for understandability of presentation and classification, they examine the due dates of notes and bonds to determine whether the debt should be classified as short-term, due within 1 year, or long-term.
Short-term versus long-term matters for liquidity.
Crucial. It's crucial for understanding a company's liquidity and its ability to meet near-term obligations. Hashtag 3.3 work, auditing presentation and disclosure related to debt.
And then, the critical disclosures for debt. What must be included in the footnotes of the financial statement so that someone analyzing the company gets the full, unvarnished picture?
For completeness, the auditor ensures all required debt-related disclosures are meticulously included in the notes to the financial statements. This is incredibly important for full transparency. It includes precise details of maturity dates, interest rates, any call or conversion privileges.
Like options to repay early or convert to stock.
Exactly. And critically, any assets pledged as collateral. Also, future sinking fund payments and maturities for each of the next 5 years must be explicitly disclosed.
Future payment obligation.
Yes. And crucially, any restrictive loan covenants.
The rules the company has to follow.
Right. These are conditions that the company must meet to avoid defaulting on its loans, like maintaining certain financial ratios. They must be clearly laid out. These disclosures are vital for investors and creditors to understand the full scope of a company's debt obligations and associated risks.
And ensuring accuracy and understandability in these vital disclosures.
So for valuation, allocation, and accuracy, the auditor diligently reads the footnotes and other related information to confirm that the information is accurate and presented at the appropriate amounts. They're making sure the narrative aligns perfectly with the underlying audited data.
Matching words and numbers.
Correct. For rights and obligations and occurrence, they compare the disclosures with other audit evidence to ensure the disclosed information has genuinely occurred and is factually correct. And for understandability, presentation, and classification, they scrutinize the disclosures for clarity and comprehensibility, ensuring any financial statement user can easily grasp the implications of the company's debt. Hashtag 3.3.4, auditing the equity balance in transactions.
Finally, let's talk about auditing the equity side of the financing cycle. This is all about who actually owns the company. What are the primary concerns for the auditor here?
When auditing equity, the auditor's primary concerns, similar to debt, revolve around completeness, all shares issued accounted for, valuation, correct recording of stock transactions, and existence and occurrence. Shares actually exist, transactions actually happened. They also pay close attention to classification and understandability of these complex ownership structures.
So how do they ensure completeness for equity, especially with all the nuances of authorized, issued, and outstanding shares?
This depends significantly on whether the company uses a stock transfer agent, if they do.
Makes it easier.
Generally, yes. The auditor relies heavily on third-party confirmations from the agent for robust evidence of the completeness of shares authorized, issued, and outstanding, as well as for individual transactions, like new issuances or repurchases. This external confirmation is incredibly strong evidence.
And if they don't use an agent?
If a client does not use a stock transfer agent, the primary source of evidence for completeness is the internal stock certificate book. The auditor will examine the stubs in this book for proper recording, review any canceled certificates, and verify the existence of the remaining unissued certificates.
Looking at the physical book of certificates.
Uh-huh. They'll also foot the shares outstanding in the stock certificate book and agree the total to the general ledger. They also meticulously examine all shares of treasury stock shares the company has bought back and agree the total to the general ledger.
And for all the required disclosures related to equity, this is where investors really get the full picture of their ownership rights, right?
Again, completeness is paramount. The auditor ensures all required equity disclosures are in the notes, including the number of shares authorized, issued, and outstanding for each class of stock, the rights and privileges of securities.
Like voting rights, dividend preferences.
Exactly. Dividend and liquidation preferences, call prices, conversion rates, sinking fund requirements, voting rights, all the complex details. Also, specific details on stock option plans and other stock-based compensation. And any appropriations of retained earnings or restrictions on dividends that might be imposed by loan agreements or state laws.
So investors know exactly what their shares entitle them to and any limitations.
Precisely. These disclosures are absolutely crucial for investors to understand the company's precise ownership structure and any limitations on its ability to pay out earnings or operate freely.
What about valuation for equity? This seems less about physical value and more about recorded amounts.
The auditor may recompute the value assigned to stock transactions that occurred during the period, especially for complex issuances like stock splits or mergers. They also analyze the retained earnings account from its inception or since the last audit, meticulously reviewing the propriety of any direct entries to retained earnings, ensuring these adjustments are legitimate and properly authorized.
Checking the retained earnings math and adjustments.
Yeah.
And how do they test for existence and occurrence of equity transactions, making sure shares really were issued or retired?
Existence and occurrence can be tested by vouching transactions recorded during the current period to board minutes, ensuring the board formally approved them.
Back to the board minutes again.
Always important. The stock transfer agent confirmation, if used, and the inspection of the stock certificate book provide strong, verifiable evidence of existence. Finally, for understandability of presentation and classification, the auditor determines whether there are restrictions on retained earnings resulting from loan agreements or state laws and inquires about any appropriations of retained earnings. These restrictions and appropriations must be properly disclosed to ensure financial statement users fully understand what portion of earnings is freely available to the company or its shareholders. It's all about ensuring transparency in who truly owns the company and what they can expect from it.
Okay, let's unpack this. We've journeyed through the tangible world of property, plant, and equipment, the human-centric complexities of payroll and personnel, and the vital fueling force of the financing cycle. What's truly incredible to me is the sheer depth of control and meticulous auditing that goes into these often unseen, behind-the-scenes parts of a company's financial world. It's like an invisible skeleton of integrity supporting the entire operation.
It really is. What's fascinating here is how these other cycles, while they may not always grab the front page headlines or dominate investor calls, truly form the absolute bedrock of financial integrity.
So foundation.
Exactly. Every asset, every paycheck, every loan at all contributes to the bigger picture of a company's health and trustworthiness. They are the critical underlying processes that, if mismanaged, if controls are lax, or if they're subject to fraud, can completely undermine a company's financial standing, its reputation, and ultimately its long-term viability, regardless of how strong its sales look.
This raises an important question, something for you, our listener, to mull over. After understanding the meticulous controls and the incredibly thorough audits in these less glamorous but utterly crucial areas, how might a company's proactive investment in these systems, not just its reported profits, but its underlying operational integrity, signal deeper financial stability and long-term reliability to savvy investors, even beyond just those top-line reported profits and losses?
That's a great point. It speaks volumes about the culture of accuracy and accountability within the organization.
Something to chew on until our next deep dive. Thanks for joining us.